To build wealth, you don't need a stratospheric IQ or inside information. Just recognize Wall Street's favorite game and refuse to play it. Most people treat the stock market like a giant electronic casino. They look at these glowing red and green tickers on the board and see abstract blips, disconnected from anything real. This creates a predictable cycle. People buy a stock simply because the price has gone up, assuming it will climb forever. And when the price eventually drops, they panic and sell. The result is an environment driven almost entirely by raw emotion and guesswork. If you find yourself obsessing over daily price fluctuations or chasing the next hot IPO, you are gambling, and in that casino, the house always wins in the end. Decades ago, a man named Benjamin Graham looked at this exact cycle and gave it a name: speculation. Graham's methodology was highly practical. He taught these principles to a young Warren Buffett, providing the exact framework Buffett used to build his fortune. Graham offered a definition that cuts through the noise of the trading floor. A stock represents a literal ownership interest in an actual, functioning business. Speculators work backward. They look at a company's market price and use that number to determine what the business is worth. True investors do the exact opposite. They calculate the real value of the business first and use it to judge if the market price makes sense. True wealth is built by looking at tangible facts, things like cash flow, real physical assets, and consistent dividends. It comes from measuring what a business actually produces, rather than trying to guess what a crowd of speculators will do next. Consider what happens when the crowd takes over. In late 1999, pure enthusiasm pushed the stock of a company called VA Linux to $239 a share. Within a few years, it crashed to almost zero. The people who bought at the peak lost everything because they paid an exorbitant price for a popular future that never actually arrived. Now look at how an investor operates, using a company like Converse Technology in 2002. Graham looked for companies trading below their net working capital. This diagram shows a scale weighing a company's liabilities and stock price against its physical assets. In 2002, Converse's market price was lower than its cash and inventory. Anyone buying shares essentially acquired a software business for nothing. The assets covered the entire stock cost. While speculators blindly pay a premium for a good story, true investors wait patiently to buy quantifiable assets at a steep discount. This mathematical discount leads directly to Graham's non-negotiable rule for building wealth: the margin of safety. Warren Buffett explains it with a structural engineering analogy. If you build a bridge engineered to hold 30,000 pounds, you don't drive a 30,000-pound truck across it. You only drive 10,000-pound trucks. This graph visualizes how that engineering principle translates to stock pricing. The tall bar represents the intrinsic calculated value of the business. The shorter bar is the price you actually pay. That gap is your margin of safety. Insisting on this gap absorbs shocks, protecting you from miscalculations, bad luck, or economic downturns. The margin of safety provides a structural framework to ensure your wealth survives an unpredictable economy. To execute this philosophy, Graham offers two distinct blueprints, depending entirely on how much effort you are willing to put in: the defensive investor and the enterprising investor. If you lack the time or desire to analyze corporate balance sheets, the defensive blueprint is required. This graphic outlines the rules. You must diversify broadly, use low-cost index funds, and put your portfolio on autopilot. As part of that strategy, a defensive investor also divides their money between stocks and bonds to guard against hidden economic threats, specifically the steady erosion of purchasing power caused by inflation. On the other end of the spectrum is the enterprising investor. To beat the market average, you must treat investing as a full-time business, relentlessly digging through financial statements to hunt down rare price discrepancies. Success requires picking one of these two extremes. You either exert zero analytical effort but maintain immense emotional discipline, or you apply extreme mathematical rigor. Trying to operate in the middle ground almost always leads to failure. Ultimately, executing either blueprint requires Graham's final lesson. The stock market is a pendulum, swinging endlessly between unjustified pessimism and completely unsustainable optimism. Accepting this reality neutralizes fear. A market crash creates a massive discount on valuable assets, driven by the panic of the crowd. Financial success requires mastering your own internal discipline, rather than attempting to outsmart the market. Graham summed up his entire philosophy with one piece of practical advice. Don't buy your stocks the way you buy your perfume. Buy them the way you buy your groceries. Thank you for watching Concept Corner. If you found this breakdown helpful, please like, share, and subscribe for more educational documentaries and deep dive explanations.